Vision Financial Podcast with Luke Smith on Canberra's 2CC.
It's a wonderful Friday afternoon. A beautiful Friday afternoon. And being Friday, it means it's time to talk money, and to do exactly that, joining us now from Envision Financial, Luke Smith. Good afternoon.
How are you, Leon? You good?
Oh, yeah, absolutely outstanding. And the weather is fantastic, and I'm looking forward to a sleep in tomorrow. I mean, the world is pretty good, all things considered. I know there's a lot of doom and gloom and nasty things happening, but still, there's some positive things to enjoy.
Oh, look, the weather out there at the moment's absolutely delightful, and if it stays like that tomorrow, popping out for a cheeky 14 holes will be most enjoyable. And after 6 months of nothing, who cares where they go, as long as you can get out and, get amongst it.
Absolutely. Do a little bit of fresh air and exercise, and maybe even get a ball into a hole. But I don't know about that. I'm no good at that. Before we start on today's topic, I just thought I'd very quickly run something by you. The people at the Australian Prudential Regulatory Authority this week decided to make it harder for people to get home loans. Now, what do you think of that move?
I think there has to be an element of protection for people getting wrapped up in the hype of what's happening at the moment. There have been a series of very unique situations, the fallout of COVID, very low cash rates, crazy property prices, and the fear of missing out is really taking over. I think it's like a seesaw. You have to find a happy balance. And as long as it doesn't go too far one way that limits people from getting in, I think protecting people and sort of tempering the greed isn't a bad thing, provided that it achieves the outcome. Because most things that happen here, there's generally, by the time the legislation or changes are made, mortgage brokers have found 4 workarounds, and it's sort of irrelevant anyway. So, I think it's a good thing within reason, but it needs to be measured in the right areas. And if they've done that and it falls in the right sectors of the market to limit the indebtedness that we're seeing, it could be a good thing going forwards.
Yeah, and they argue that it will help to reduce the rapidly growing prices of properties, slow down that price growth a little bit, so that it addresses the affordability question. But that would be a long and slow process unless you see prices actually fall, and then that brings other problems, doesn't it?
Yeah, it does. And I think the thing they need to consider with most of these things is the bank understands its cash flow modelling. The bank understands the risk it's taking on. I think if you ask the average person to break down their capacity to have a backup plan in relation to their cash flow, the emotion of buying something overtakes how people live and the true understanding of someone's budget. And I see regularly that, 9 out of 10 people wouldn't have a budget if they wrote it down on a piece of paper. So it's very difficult to become heavily indebted and rely on cash flow, either with limited insurances or limited spare funds in case rates do rise or someone loses a job. So, I think people need to be saved from themselves in a way, because emotion takes over, especially with a property purchase. It's a tough one.
In today's topic, are all super funds the same? Well, I presume it's pretty self-evident that they're not. So then the question becomes, how are they different? Well, when it comes to choosing super funds, the one I want is the one that I can't get, and that is the parliamentary super fund that, the politicians, they're on a pretty good wicket, aren't they?
Yeah, them and the judges, they've got a good setup. And looking at the way that the legislation is continuing to hinder people from being able to grow their wealth and all of the various taxes that are getting implemented, you'd sort of question the outcome of the legislation on that front, and making it harder and harder for people to retire. But today's really just about sort of demystifying what super funds are, some various structures that are available, and things that people can consider when looking at a fund, because they're really not all the same, and it really depends what you're after. And when we talk about risk, we talk about how fast the car goes. This is very similar. If we use that same car analogy, it's all about the features. Do I need a reversing camera? Do I have ABS brakes? Do I have cruise control? How big are my tyres? And super funds are exactly like that. Some funds offer a huge amount of investment options and have great controls, great administration, numerous insurance options, and some very, very cost-effective investment structures that people can take advantage of. Others have 3 or 4 generic options. You get what you pay for, and hopefully you're not paying too much for them. So we'll just break down today some of the differences between the various structures, and then some things people should look for depending on what they need, because that's the important thing.
Yeah, and of course, so when we ask the question, are all super funds the same? Of course, every different super fund has a different mix of investments, different features, different optional extras and so forth. But at the very fundamental level, there's a few different structures. There's a few different specific types of super fund, aren't there?
Yeah, that's right. So we can sort of break it into sections. And it's not to say one is better than the other, because like all cars, I'm 6'5", and I may not actually own a Mini because I probably wouldn't get in one. That doesn't mean I'm anti-Mini. That's just not right for me. And that's what people need to keep in mind when it comes to these sorts of things. So you've got industry funds. Everybody's pretty comfortable with an industry fund. You've generally got some generic options, balanced, high growth, and the underlying investments are done for you. You may or may not get any control over the use of franking credits. You may or may not have access to listed shares. Some industry funds will have a listed menu of the ASX 200 or 300. Some will offer ETFs, others won't. So it pays to look under the hood in relation to the fund that you're in or the one that you want to use. And there is some generic insurance that will be issued to you upon your membership being accepted. So that's your simple, basic sort of structure. Limited options in most situations, limited controls, and generally no access to specialised managed funds. If we then come up the rung, you've got a master trust. And a master trust is a superannuation fund that will allow you to buy into a range of diversified managed fund options. It will have a limited investment menu. You may or may not be able to buy some index-based exposures, which could be the ASX 200, the S&P 500, and some broader, cheaper indices. You'll have an insurance option, and there's generally no admin fee or a very low admin fee because it is a cost-effective structure. And what you're saying here is, I'd like to have some options and some control, but I'm not looking for all of the bells and whistles. And importantly, with a master trust, all of the capital gains tax is facilitated at the fund level. So you're not having to worry about your individual capital gains tax position, because the ins and outs of all of the members is reflected in the unit price. So it's a slightly different way of operating a fund. If we then step another two to the left, we go into the personal super fund environment. Now, I find this gets muddled together with self-managed super funds very often. People will come in and say, I'd like a super fund. I'd like to buy shares. I'd like to be able to buy exchange-traded funds, listed investment companies, and have a range of specialised managed funds, because an individual person might say, well, I really like healthcare. I really like technology. I'd like to have an exposure into Asia or emerging markets or a specific area that they may like more than others. And a personal superannuation fund has a very, very wide investment menu. It is structured for the needs of your individual account. So the capital gains tax or the growth and tax implications of your account is done for you, not for every member, as we saw with a master trust. So it's far more personalised. There'll be a much wider range of insurance options. You'll be able to hold term deposits, specialised managed funds. A good personal super fund will have 400 or 500 different managed fund options. It'll generally cater to the ASX 200 or ASX 300. You'll also be able to buy exchange traded funds in a range of different sectors. So it's a very good way of getting a superannuation structure for yourself that you are not the trustee of. A personal super fund would be issued by some big names that most people would know, a Macquarie, a Colonial, an MLC, where they act as the trustee and they tell you what you can buy, and that's called an approved product list. So if you want to buy some sexy stuff that's a little bit out of left field, check that it's on the approved product list, because if it's not on there, you won't be able to buy it inside your fund. So we sort of started at the basic level and we've moved our way up. And then I guess the Ferrari of the superannuation environment, using the car analogy, is a self-managed super fund. Now, a personal super fund and a self-managed super fund are very, very similar in that you'll have a much wider range of investment options. a key difference with a self-managed super fund is, generally speaking, you are the trustee. So you take on that responsibility of running the fund and adhering to all of the legislation that the superannuation environment requires. You can pick the assets, you can decide what you buy, when you buy it, and the proportions with which you hold things. And a big point of separation that is enjoyed by self-managed super fund holders is that you can hold residential or commercial property inside the fund, as it is the only structure that will allow that in the superannuation environment. So again, it's not for everybody, and it's important that people sit down and say, what am I looking for in a super fund? Just like they would in a car. Do I want a reversing camera? Do I want ABS brakes? Do I want auto braking? Do I want 5 seats, 7 seats? Do I need a wagon? Do I need a sports car? And look at your super fund in a similar way. If you're not too fussed and it's something that you go, well, I'll look at that in 30 years, then an industry fund or a master trust may be appropriate for you. I find as people get a little bit older and a little bit closer to retirement, they start to become more focused on the income that's being generated from their investments, because that can give them a lot of peace of mind around how pensions will be funded in retirement. And then they start to become more engaged in their asset allocation, the underlying investments. You get a little bit older and a little bit wiser, and you start to buy some shares. You want to use franking credits. So as your intellectual exposure to super sort of builds as you get older, I find people move up the rungs in relation to flexibility. And it may or may not culminate in a self-managed super fund, because they are very cost effective for higher balances, or they're also very advantageous for the self-employed people that want to own the premise that they operate their business out of. So there are some quirks and some advantages that may not apply to all funds, but it's important that people get what they need and something that's right for them.
There's a couple of different things here. When we started off talking about industry funds, at that level, there's a couple of different options. There's industry funds that are operated by the not-for-profit sector. Then there are retail funds that are operated by financial institutions, which are, generally speaking, making a profit, whereas the others are a non-profit arrangement for in some sort of fashion. Does that make a difference to the choices that people make?
It can do. Again, it's a fund by fund thing. Where you are making some profit, there's generally a lot of money getting made. We can't sort of assume that an industry fund isn't there to make cash. They make copious amounts of cash because they sponsor every sport on the earth. We see that on the telly every week. So there's plenty of money sloshing around. But it can have a lot to do with their approved product list and what you can and cannot buy. And that's why I think it's important that we don't lump industry funds as they are all the same in their sector. They are very, very different. And depending on the scale and the size of things, they can have some very innovative products, and others can be very, very basic. It just depends what you want to be exposed to.
The last week or so, people have started receiving letters from the authorities saying your super fund has been found to be underperforming. Now, this is part of the new regulation regime that's been introduced by the government, requiring such things to be reported to people so they can then consider their position and make a change. So if somebody receives one of those letters, what should they do, and what should they think about in looking for an alternative fund to the one that they're currently in?
Yeah, look, that's really good. And it was on the news a couple of weeks back. And again, like most reporting on something, there's a lot of scare tactics out there that, there was a comment that, Colonial First State had an underperforming fund. Now, Colonial First State might have 50 different funds, but the My Super, which is your bare bones, super generic, park my super there because I don't want to do anything with it sort of fund, is what they've used as a measure of whether something is performing well or not. If you're in a fund like that, just consider your options. Look at your current provider and see if they have a more flexible fund with some better options. Maybe widen your investment menu, consider your underlying investments, and make sure that you have an understanding of what you're invested in. Because comparing one balanced fund in an industry fund to another can result in two cars driving at much different speeds. Because as we said in a show maybe last year, I don't know what balance means anymore. After 20 years in an industry, the term balance scares me because it could mean one of about 36 different things at the moment. So have a look at your asset allocation, make sure it's invested, in the right way for you, and then consider some other options in relation to where you could go. Look at the things we've discussed: investment menu, underlying fees, charges, admin, internal cost ratios. Can I buy listed shares? Do I want to buy listed shares? Can I buy an ETF? Can I use an index? Just make sure that you've got a fund that gives you lots of options, lots of controls, like a plumber in his toolbox. They don't turn up at your house with a Phillips head and a monkey wrench. They turn up with a box full of stuff because they don't know what they're going to need. And the super fund investment menu is a very similar analogy.
Well, we've covered a lot of territory already, Luke, so I guess the time has come to ask key things for people to consider when looking for an alternative to their current super fund.
Yeah, look, I think if you're going to compare something, don't compare something just on performance, because you need to understand what's been done to achieve that performance. And that comes back to that comment about, are all balanced funds the same? If one car's going at 140 kilometres in a 100 zone, and another car's doing 100 kilometres in a 100 zone, there's no way the car driving slower can beat the faster vehicle. Similarly, one balanced fund is not going to beat another where they are taking on more risk. So look at the underlying asset allocation and make sure it's right for you, because you can't just assume that they are all running at the same speed. Look at the investment menu. Look at things that you can use. Can I buy listed shares? Can I buy exchange traded funds? Can I buy listed investment companies? Can I buy things that are really, really cost effective to keep my investment costs within the fund as low as possible? And that's where ETFs give you great diversification at 0.2, 0.3%, which is very advantageous. Look at aggregation of multiple accounts. A master trust or a personal super fund will allow you to have 2, 3, 4, 5, 6 accounts across a family group and aggregate the pricing so that you get much better rates when they look at the collective value of the funds. They then lower the price, because a lot of personal super funds, the pricing structure is the higher the value, the lower the cost on a tiered scale. So if you can use fee aggregation, it can be really advantageous across a family or a business group. Look for a fund that has multiple risk options. Some funds will have 1 or 2 providers. Other will allow you to take advantage of a number of different options, which can lower your underlying insurance fees where you have life and TPD or income protection through the fund. And look at a fund that has really good administration flexibilities. Can you access money easily? Can you do it online? Do they have an app? Can you start a pension very quickly? So administration leading into and in retirement can be very advantageous, because it can remove the angst associated with funding lifestyle and getting hold of money. And make sure that the trustee structure is right for you. If you don't want to be responsible for something, don't go down the road of a self-managed super fund. Maybe come one back and use a personal super fund so that all of the compliance requirements are done by somebody else, and you can just get on with investing, being retired, and using your money to fund lifestyle. So there's some key things I'd be looking at if I was going to change funds or consider a move in the future.
Indeed. So, Luke, where can listeners get more information?
Yeah, so you can ring the office 02 6260 4749. We've got envisionfinancial.com.au. That's envision with an E. We've got the website there. You can subscribe to the Knowledge Centre. That's all free. We've got the podcast, The Strategy Stacker, Luke Talks Money, on iTunes and Spotify. And you can subscribe to the YouTube channel where we've got all of the shows. You can watch them on your iPhone, pause it, take some notes, and we've got the key takeouts before and after the ad break to try and highlight the things that you can consider for yourself. So there's a little bit there for everybody.
There certainly is. So any questions, get in touch with Luke at Envision Financial. Luke, thanks very much, and we'll chat to you again next Friday.
Thanks, mate. See you then.